Welcome to the Strategic Investor. Join us as we interview some of the world's most productive asset managers and uncover sophisticated and unique investment strategies in the markets. Here is your host, Charlie Wright.
Hello and welcome to Strategic Investor Radio on OC Talk Radio, where we bring you investment strategies you are not hearing elsewhere. We'd like to welcome for the very first time on our show, Peter Hugg, Director of Global Trading with Kitco, a precious metals dealer with offices in Montreal, New York City, and Hong Kong. Peter, welcome to Strategic Investor Radio.
Pleasure to be here, Charlie.
So, Peter, you started in the precious metals and foreign exchange industry, 1973. I'm sure right after kindergarten here. You joined Kitco in 2010, so you have a very long career. You have retail and wholesale clients for precious metals, and you know most everyone in the industry. So we'd like to start, Peter, with, would you give us some insights into the industry of precious metals? That's an industry that very few people know. I am next to totally ignorant of how that industry works, what it's about, etc. Are we talking about millennials who are involved? Are we talking about old folks who have an attitude of gloom and are looking for the second coming here, and conspiracy theorists? Are we primarily into industrial uses these days? Is the China's corner on the market for rare earth metals? Is it a big deal? Where is the industry today, especially compared to what most of us have known and kind of seen and understood or believed, for the past 30, 40 years?
Well, Charlie, actually, it's almost identical to where it was when I entered the industry back in the early 70s. I looked at it actually about 3 years ago when I was speaking on various conference venues, and I just wanted to compare, what had changed in the 40-odd years I had been in the business, relative what offerings and what participation was evident in the precious metals markets from the early 70s through the first gold and silver rush in 79-80, when gold hit $850 and silver first hit $50. And I wanted to just sort of compare then and now. And, there's very little that has changed as far as the offerings that are in the market today relative back in the 70s. I mean, one of the obvious differences today, other than when I started in the business, is now we have computers. Now I do my business not on IBM Selectric typewriters, and everything is not done over the telephone. It's all done digitally and, via computer. And so the speed of transactions has obviously increased considerably since the 70s. The participation in the market from not only retail dealers but also wholesale market makers has also increased dramatically because of the reach, the global reach through the internet that has now opened up since the dawn of the internet and the digital sort of transformation that we've seen over the past 20 years. But the product offerings, ironically, remain relatively similar. The only thing different today than that we saw back in the 70s when I got into the business was now you have ETFs, and you also have certain hybrid products where you can trade ratios between two metals. But the actual basics of the investing in the precious metals business, buying physical product or doing futures contracts or options, managed accounts, or investing in gold mines or shares just generally in the precious metal space is very little changed from what I experienced back in the 70s.
Peter, that's interesting.
Yep, I'm sorry. Go ahead, Charlie.
Let me ask, there are two significant changes that have occurred in the financial marketplaces in the world. Tell us how they have impacted precious metals. One is China. I mean, 1973, nobody in China had any money. Okay. And today, that's where one heck of a lot of money is. And number two is cryptocurrencies. I mean, that has got to be a competitor with gold for the conspiracy theorists and people who believe that, governments are going to run currencies into the ground and that kind of thing, which has been a hotbed, an issue for anybody interested who has gone to gold. And there are probably others, but those come to mind. How have those two impacted gold, or have they impacted it much?
Well, I think China coming into the modern world, and the middle class in China now having some, from a perspective of spending capability, that was not obviously the case in the 70s and 80s, and actually even in the 90s. I mean, so you are seeing the fact that China, the population of China that is capable of investing in gold, has certainly increased the demand for gold, and we certainly see that out of our Hong Kong office. So that's just really all that is just another demand cycle coming into the equation. But at the same time, China over the past 20, 30 years is also a significant producer of gold internally, although they do import gold to meet their reserve requirements and to beef up their central bank reserves. China is a relatively large producer of gold, which was not the case back in the 70s and 80s. As far as cryptocurrencies go, I agree that back, a couple of years back when Bitcoin went up to $19,000, there was definitely competition relative to gold. But, Bitcoin's now south of $4,000, so the bubble has come out of that market. And it's really illustrated the volatility of the crypto market. Now, I'm not suggesting that crypto is not a good investment, but the fact of that volatility going from 0 to 19,000 and then back to $3,800 has really created a lot of hesitation from the point of view of new investors entering into that market. There's just a little too much uncertainty, and what type of regulations might come down the road relative to crypto market. So that's sort of prevented a major competitive force against the precious metals markets. And, when you look at gold, I mean, I don't want to be one of these guys, on an interview that says, the world is coming to an end and gold is going to go to $10,000 an ounce. I mean, gold's not the end-all, be-all. It's a commodity. There are times when gold does extremely well, and there are times when gold does extremely poorly. We came out in September of 2018 with a very aggressive buy on gold, but it was premised on fundamentals that we believed would occur in the future, and those fundamentals are starting to come true. We're not in the camp that believed the Fed was going to raise interest rates 4 times in 2019. In fact, it appears they're not going to raise it all in 2019, and now there's even a chance that they may even lower rates sometime near the second or third quarter of 2019, depending on economic recovery. So when you look at sort of the macro picture of what's going on from an economics perspective and a geopolitical perspective, you then sort of lay that over where the gold price is, and then you make a determination whether gold is a good or a bad investment. Once you make that decision, then there are a number of vehicles, whether you want to be bearish or bullish the gold market, for you to execute your strategy. So I look at gold as nothing different than Apple stock. I mean, people look at Apple right now and they say it's a great company. Well, anybody that bought Apple stock 5-6 months ago at $225 would disagree with you.
Yeah, right.
At $160, Apple looks pretty attractive. So, it's got to do with timing. It's got to do with cycles. And right now we think we're in a very constructive cycle for gold, and we think it's got not much higher in the sense that I'm not calling for 5,000, but we're constructive on the gold price. We think it's got more room to move higher from these current levels, even though it's gone up through 1,300 over the past few days.
So tell us, Peter, how does one invest in gold today? I mean, there's obviously the GLD ETF. And then you hear advertisements, commercials about buy gold coins, that kind of thing. How does one invest in gold?
Again, when somebody says to me, and most of the conferences I go to, and again, I did I did a look back as well on sort of the questions I was asked back in the 70s and 80s when I was in the wholesale business, running a wholesale desk, as opposed to what I'm doing now, which is more retail oriented for Kitco. Was clients ask me, should I buy gold? And it really comes down to me not answering the question, but asking the client a question in response, and that question is, what's your motivation? And, why are you buying gold? Why is it that that's triggering something in you? And there is a group that believe that the fiat system globally is going to collapse, and the governments are invasive, and they want to hold gold, and they don't trust institutions. So this group of investors will not be buying ETFs. They're reluctant to hold their gold with dealers and allocated accounts. They're reluctant to buy mining shares. They don't trust anything that is sort of an organized market. So what they want to do is they want to buy physical gold. They want to take delivery of the gold and then have that gold when, in their minds, Armageddon comes. So the physical market is a very fluid market. There's a variety of things clients can invest in, anywhere from 1 gram of gold, which is a 32nd of an ounce, all the way up to 400-ounce gold bars, which is what you saw in the James Bond movies back in the 70s. So there's a wide range of not only bars but coins that you can buy when you're looking at physical gold. For investors that don't have that same fear from a perspective of institutional risk, they have access to ETFs, they have access to gold mining shares, they have access to managed accounts in gold, and you can buy gold not only from a point of view of diversification of your portfolio, but you could buy it from a perspective of geographical diversification. So, for example, an American can buy gold and hold the gold in Canada. They can hold the gold in Singapore, hold the gold in Hong Kong. So they have some of their assets outside of their jurisdiction of residence and still be able to benefit from the appreciation of the asset that they're buying, but also have the ability, should they decide to leave the country, to have their assets already sequestered outside of their country of residence.
So, Peter,
the options are multitude.
Okay, and it sounds like it. We're glad that you're there with 40-plus years of experience here to tell people about it. So, are institutions buying gold? University endowment funds and pension plans for unions and things like that?
Again, that's not a yes or no answer. I would say some are. Some of the managers of these pensions and the endowments and just generally mutual funds see the logic of holding a position in precious metals as part of a balanced portfolio. Recently you're seeing people coming out of the woodwork that really haven't expressed an interest in gold, such as, Jim Cramer, a couple of billionaires that have come on, some of the financial networks that have now expressed that gold should form a portion of your portfolio. So it's really something that you look at as part of a balanced portfolio, and what a lot of people or a lot of analysts have been saying over the years, and I agree with the first principle, but they never finish the statement. They indicate that you should hold 5 or 10% of your portfolio in gold, and then they put a period behind that sentence and they move away. The thing is, it's not a static investment. Gold is just like Apple or it's just like your bond, a portion of your portfolio. It's something that needs to be managed. So if you go into the concept that 5% of your portfolio should be in gold, whether that's in physical gold or in ETFs or in gold mining shares, you don't just buy it and forget about it. You don't just buy a stock and forget about it. You manage it. So you recalibrate your portfolio every 6 months. And just to give you sort of a simple mathematical type of example, if you were to buy gold at $1,000 and that represented 5% of your portfolio, if in 6 months gold was at $2,000, it's likely that your gold position in your portfolio now probably doesn't represent 5%. It represents 10%, maybe 12%. You need to sell that 5 or 7%. Vice versa, if you bought gold at $1,000 and it's now at $500, it probably now doesn't represent 5% of your portfolio. It represents 2%. You need to buy 3%. So you need to have a plan, and if your plan is to hold sort of a 5 or 10% weighting in precious metals as part of an overall balanced portfolio, you need to mark that to market and trade it accordingly. And if you do that with your precious metals position in your portfolio, you'll find that when the markets move higher, you'll lighten up on your precious metals position to retain your 5% weighting. And if the markets move lower, you'll buy more, also retain that 5% weighting. So you'll be exiting the market on strength and entering the market on weakness.
Well, those are some great points there. And I would completely agree with you that gold does not get the action, the activity by investors, and they just kind of buy it and set it aside. Let's move on for a minute from gold. Why should investors consider other precious metals, and what do you tell people about that?
Your primary focus, or the primary focus tends to be with investors, tends to be on gold. They don't tend to listen to anything else. Now, silver tends to get some airtime because silver, from a percentage perspective, tends to outperform gold both on the upside and the downside. So if you're bullish gold and you don't have the capital allocation to be able to buy gold at $1,300 an ounce, and you're looking at silver, which is at $15.90 an ounce, you'll get more. You may get more traction buying silver with the anticipation that the market is moving higher. So silver tends to be a sister metal to gold, although it does tend to also have an industrial application which could affect price up or down, irrespective of where gold is going. But it does tend to mirror the price of gold in a higher percentage move. Now, when you get to the more, let's say, I'll call them exotic metals because most people have never heard of them or they've never taken the time to learn about them. Metals such as, palladium or rhodium, for example. 3 years ago, we gave a strong signal on both palladium and rhodium. Rhodium was trading at $700 an ounce. Today, it's at $2,500 an ounce. Palladium was at $650. Today, it's trading at $1,350. So there are opportunities in what is classed as the PGM metals that are almost entirely industrial based, but that are much more sensitive to supply and demand issues. So there are opportunities in those metals as well, except that people just don't understand them, so they tend to stay away from them and sometimes miss opportunities that have been actually extremely great over the past 2 or 3 years.
Okay. How about the political situations and concerns about, these things are done in various areas that are not that politically stable? Is that a concern of many people, or should it be a lesser concern or greater concern? How do you see that, Peter?
My track record when I look at gold is I tend excuse me. I tend to value the macro picture on gold from a fundamental perspective based on carry cost of my investment. And if you look at gold in 2011, interest rates went to zero. They stayed at zero for through about 2015 before the Fed started tightening. At that in that time window, the U.S. dollar, because interest rates were at zero, was under pressure, and you had a situation where gold was rising. When the Fed started to reverse course on interest rates around 2013, I believe it was, the dollar started to appreciate in value, and as a result, gold came under pressure because most commodities are valued against the U.S. dollar or priced against the U.S. dollar. And that scenario of the Fed tightening with a stronger dollar has created the drop in gold over the past, from the high of 2011. But it appears now that the Fed is going to back away from raising interest rates, and that should weaken the dollar in 2019, and that's why you're seeing the price of gold starting to move higher again. In August or September of last year, when we called the bottom, gold has since then appreciated 12%. The Fed meeting is today at 2 o'clock. It's anticipated that they are not going to raise interest rates today and probably give forward guidance that it'll be data dependent, which indicates to me that given the economic growth that I'm looking at in the U.S., it's probably the Fed is probably not going to raise rates for the balance of 2019, which should put pressure on the U.S. dollar, which should be price positive for gold. Now, that's fundamental. Now, if you look at the other issues that could move the price, which I think you're referring to, those are what I would consider the geopolitical issues. So you have issues potentially with North Korea. You have potentially issues with the Chinese trade war. You have potential issues with Iran. Those types of spark points tend to move the price of gold up or down depending whether they're resolved or not. But those tend to be temporary because when you get a flashpoint, like when we had an issue with Cyprus 3 years ago, you tend to get a move up in gold, but then once it's sort of resolved, the movement is basically evaporates back to where the fundamentals are. And the fundamentals on gold right now are the carry cost of the metal and the value of gold relative to the U.S. dollar. And if we're right that interest rates are going to stay stagnant or actually move lower and the dollar is going to weaken, then it's constructive to be along the gold market even at current levels.
No, that was great. That was right out of an encyclopedia somewhere here, Peter. We really appreciate that input, and the relationship with the U.S. dollar. So let's change direction a little bit here. What's the best advice that you've ever heard, read, or received about investing?
Well, the best advice, unfortunately, most people have difficulty following it, is you've got to cut your losses and ride your profits. I know that sounds really easy, but it's extremely difficult to do. People get into something, whether they hear it from their neighbor or they watch a financial news network or or they're watching a television show and there's an ad that comes on television, and they get into an investment. And, the first thing, they don't understand what they've bought. They haven't done any research. They just heard that it was a good thing, so they buy it. And you need to set yourself a stop. It doesn't matter what you're buying. Again, let's use the Apple example. So you think Apple at $220 was a great investment. Well, in your mind, you've got to set a stop. And when that stop hits, you have to get out. You can't say, well, I set a stop at 210 and sort of at 210, but maybe it's going to bounce, and then it goes to 205, and then you go, well, it was just at 210. I'll wait for 210 again, then I'll get out. Next thing you know, it's at 195, and you just don't get out. That's the first discipline. The second discipline is you've got to ride your profits. So let's assume you bought the Apple at 220, and now it's at 230. And it looks like it might have some legs. So now it goes to 240. You put a stop in maybe at 230 for maybe half the position or 3/4 of the position. If it goes to 230, you get out, take your profit. If it runs to 260, you raise your stop. But what people tend to do is they tend to buy something and they just hold it and hope. And, I had a buddy that was a broker that I dealt with in the 70s, and I'm not going to use the analogy because it's not a pleasant analogy, but he basically said, if you buy a dog at $8, it's not less of a dog if it goes to $6.
That is interesting. I have never heard that little analogy here. So, but those are great points. And moving your stop there, that's one of the smartest things in terms of trade execution that any investor can do, and I just don't see people doing that much here. Another question we like to ask all of our guests here, Peter, what keeps you awake at night?
Worrying about my children.
You're not alone there.
I'm 67 years old, and I've gone through it all, and I'm worried about the future. I really am, and I'm not so much worried about the financial future. I'm worried more about the moral future of where I'm seeing sort of North America and generally Western civilization going to. And every year, our moral compass tends to dip a little lower. And I don't think that's a good thing. And I'm concerned about, what this world is going to look like in 20 or 30 years. I'll be long gone. And what my kids are going to have to face. So if anything keeps me up at night, it's sort of worrying about, how they're going to manage moving forward. And, we've all done it. And, maybe everything will work out and they're going to have to deal with what they deal with. And maybe everything will come out on the right side down the road. But it certainly feels a lot more difficult nowadays moving forward, especially for the younger generation than it did when I was a kid. When I was a kid, I had nothing. I mean, basically, we were walking with our heads down on the ground looking for pennies as we were walking along the street, and we didn't think anything of it. And, we had jeans with holes in them long before it became fashionable to buy jeans with holes in them. And but everything just seemed normal, and we went out at 16, got our jobs, part-time jobs. All tried to get to school and had to pay for it ourselves if we did. But it seemed normal. It wasn't a burden for us. And just nowadays, it just seems almost extremely difficult for the younger generation to be able to move along that path unless their parents sort of help them out or they have some kind of resource to rely on. So that's what keeps me up at night.
No question about it. I heard a quote recently where that there are enough prophets of gloom that to keep anyone from wanting to get out of bed in the morning. And no question about it, my wife and I have 7 kids. And so we have those very, very same concerns that you have for children and grandchildren and all of society and the like. And all anybody has to do is look at Google News or Flipboard or, LA Times, especially New York Times, and get discouraged and the like. So let's keep our fingers crossed that things do improve here. Speaking of improvement, last question on things we like to ask our guests. What book on investing would you recommend for our listeners, Peter?
Trying to think of the title. It's about a monk that buys a Jaguar. Is it a Jaguar or a Ferrari?
That's not one I'm familiar with. Paul, you familiar with that?
Not me.
Yeah,
most of the monks I know don't drive Ferraris.
Yeah.
I know, but I read it and it really resonated with me, and I think it's called The Monk That Bought a Ferrari.
Okay. Remember the author?
I'm sure if you. No, I don't. This was a ways back. And as far as investment books go, they're cool. I mean, my only caution to investors is, 2 things. One, when somebody gives you some advice, find out what their motivation is behind the advice. I mean, are they making money on that advice?
Great point.
You get these metals dealers that are, I'll buy this because gold's going to 5,000, but they make their money selling gold. I mean, it's they're not likely to come out and say, I don't think gold's going higher.
Right.
So, sort of measure your action based on the advice you get and where the advice is coming from. Like, what's the motivation in behind it? And, stay away from people that try to scare you. I mean, I'm not suggesting that people, that analysts and writers sometimes have really good points as to worries about where the economy is going and things like that. But, people say the world's coming to an end and gold is going to $10,000 an ounce. I mean, just take that with a grain of salt. I've heard that story since the 70s. Maybe one day it'll happen. But again, just don't sort of get caught up in the blindness of that. Try to do your own work on it and try to figure out where this is coming from and what's behind the statement. Is it because they're selling gold and they want you to buy it, or just try to analyze a little bit more before you sort of jump in with just out of blind fear.
So and I do have the book. I looked it up for those listening now. We're all running to Google, look it up. It is called The Monk Who Sold His Ferrari, and it's by Robin Sharma. The Monk Who Sold His Ferrari by Robin Sharma, and then there's a follow-up book by another author, I Bought the Monk's Ferrari.
Okay, thanks, Paul, for finding that for us. Appreciate it. So give us contact information for anyone who'd like to know more here, Peter.
Well, again, and this is not a promo on Kitco. When I came sort of out of retirement, when Kitco approached me in 2010 and asked me if I would run their precious metals division, I sort of looked at the company, and what I found really refreshing about Kitco is if you go on Kitco.com, you'll see some 30, 40 sort of stories a day, various reports by various authors that are in the industry that some are bullish, some are bearish. It's very neutral. It's not all bullish. It's not all bearish. And what I liked about that was that clients can at least take the time to educate themselves and understand the market and understand why markets move. And then if they then make a decision to enter the market, then they at least have some basis to go into. So at Kitco.com, you can at least get the information as to why markets have moved, what professionals in the market think to the trend of the markets, so that you can get yourself up to speed as to what you're investing. And I think that's very important. If people want to reach me directly, they can reach me at phug@kitco.com. I can't promise you I'll give you an answer the same day, but I will promise you that I will get back to you with any response you give me or any questions that you pose to me. So that's basically how you can reach me. And as far as getting market intelligence, Kitco.com, I think, is one of the best sites in the world.
Sounds great. That's Kitco, Kitco, correct?
Correct.
Okay. Well, Peter, thank you very much for joining us today. This has been very interesting, enlightening on a subject that, most of us know very, very little about. So our best wishes to you and Kitco for continued success, and we'll keep our fingers crossed that gold does not go to $10,000 an ounce here, because that would not be good for the vast majority of us here. So, Peter, thank you very much again for joining us, and our best wishes here.
You're welcome, Charlie. It was my pleasure. Thank you.
Again, we've been talking with Peter Hug, Director of Global Trading for Kitco, a precious metals dealer out of Montreal, New York City, and Hong Kong. You've been listening to Strategic Investor Radio on OC Talk Radio. Please contact us at info@strategicinvestorradio.com. Go to our website to hear podcasts of all of our interviews and shows, strategicinvestorradio.com. I'm Charlie Wright, wishing you an enjoyable week and productive investing.
Strategic Investor Radio is a production of OC Talk Radio and is provided for educational purposes only. Content of this program and the views of the guests should not be considered as recommendations by OC Talk Radio or investment advice from the host Charlie Wright or any other entity attached to this production. Investors should always consult qualified financial, investment, tax, or legal professionals prior to investing.